We were all watching that news conference, and it didn't start terribly, and then progressively it just got more and more confusing. What was the point in that news conference where you sat up and said, this is weird?
Well, it's weird when you're not explaining why three people are dissenting, yet the committee is deciding on no change in policy. There really was virtually no information about how the Federal Reserve is thinking about monetary policy, how the Federal Reserve is likely to react to incoming information in terms of how they adjust monetary policy. The silence of Warsh was really quite deafening, and the financial markets, basically said thumbs down. I mean, the fact that the 30-year yield went up, the 10-year yield went up, and 2-year yields dropped really was a sign that that there was a loss of credibility from that press conference.
Bill, I want to highlight a distinction because I think it's important, and it's in the body of your op-ed, and I want to say it for you. You're not against reducing forward guidance. This is important. I think that the complaints about the people doing the complaining often are around the idea that somehow we still want our hands being held, that we want to hold on to the post-GFC communication architecture. And Bill, I don't think that's what your criticism is about.
No, I mean, I wrote a group of 30 paper that we published in April, and one of the recommendations was to get rid of forward guidance. The only time you really need forward guidance is when you're at the zero lower bound for interest rates and you're trying to provide additional monetary policy stimulus. But the rest of the time, it really just sort of inhibits the Fed and probably makes the Fed a little bit slower to react to incoming information. But that doesn't mean you don't want to know what the Fed's monetary policy reaction function is. And I think that's the real problem. Warsh in his comments is conflating the two, and they're very, very different. If I don't understand how the Federal Reserve is going to react to incoming information, I can't price financial markets correctly. And it's also creating a lot of uncertainty about what policy is going to be in the future. The market response on Wednesday was really Fed credibility has lessened, and I think this is a really own goal on Kevin Warsh's part. I think one of the problems here, I think, is he's overpromised and underdelivered. He talked about sea change at the Fed, radical regime change, but then the markets are actually getting very, very little in terms of guidance on how to think about the new Fed.
Bill, we were discussing about whether maybe some of this was by design. There is going to be more volatility. There has been more volatility both at the front end and the long end in response to every economic data point and comment coming from anyone on the Federal Reserve as a result of an absence of some sort of reaction function articulated by the FOMC chair. Do you think that this could be by design to help reduce inflation without hiking rates?
I don't think this is a really great strategy for a couple of reasons. Number one, it's a very inefficient way of tightening financial conditions. Basically, you're driving up risk premium in markets. That's a deadweight loss to the economy. Number two, how well can you actually control the market process to generate the impulse that you want to slow the economy down sufficiently? And lastly, it's a credibility issue. I mean, if to the extent that the markets reacted the way they did on Wednesday, that's telling you that people are more worried about the Fed's resolve to do the job. That means inflation expectations are less well anchored than they were prior to the press conference. That in itself makes the Fed's job harder.
Bill, how high is the bar for there to be, I don't want to say mutiny, but the bulk of the FOMC committee voting against the chair, potentially with the governors joining suit?
I don't think we would get to that. I think at that point, Warsh would throw in the towel and vote with the majority. I can't imagine a situation where the chairman allows himself to be outvoted by the committee, because if you had that result, it basically would be saying that the chairman has lost control of the committee, and that's just not a very good look for any head of any organization.
But it was also vague about the inflation target. That was confusing too. Vague on the inflation target, whether they'd respond to it, and what tool they would use to respond. Can I pick up on that last point, Bill? He's flirting with the idea of using balance sheet instead of short-term policy rates, short rates.
Well, I think
what do you think of that?
I think the problem here is that even if you reduce the balance sheet, you're probably going to be able to reduce it by about $1 trillion or so if you want to continue to have an ample reserves regime. And I think the commitment of the committee is to maintain the ample reserves regime. And then the question is, how much restraint is shrinking the balance sheet by $1 trillion going to be? It's actually going to be very, very small. So the idea that you pull on this balance sheet lever and that allows you to not have to tighten monetary policy, I think is very much exaggerated.
It's obvious that for the market, the primary tool is still the policy rate, because
Absolutely.
You can see that in the reaction this morning to the sensitive economic data that we got moments ago on wages. They came in hotter, labour costs. You saw yields rise at the front end of the curve. Bill, we've talked about this all morning, the credibility hit. You say credibility's been hit. Others agree with you. Let's talk about how you repair it. When you do a job really badly, sometimes you have to do more than you otherwise would have had to do. How much more do they need to do now at this Federal Reserve to regain that credibility?
Well, I think you have to follow up talk with action. So I think that what's happened in financial markets over the last, 72 hours or so basically increases the pressure on the Fed to act in September. If it's a jump ball in September, you almost need to tighten now because you have lost credibility over the last couple months.
Do you think that it increases the chance of a larger than expected rate hike?
It's possible, but I don't think that you're so far away from your inflation objective that you need sort of shock therapy. If the Federal Reserve did 50 basis points move, that would be, in my mind, a little bit of a sign of desperation. Why didn't you hike in July and then you do 50 basis points in September? I think that's actually is a confusing narrative as well.
What do you think the overall motivation is here? I mean, we've been talking about this, and a lot of people said Kevin Warsh is a 100% respected person by the mainstream of the financial markets, by the establishment. Do you think this is just rookie's error, the classic kind of first press conference of a Fed chair? Or do you think that there is some political motivation here trying to dodge the ire of the president going into the midterm elections?
I can't judge that, but I generally think, no, that he's not trying to do it to sort of mollify the president. I think he really does believe that somehow outsourcing this to financial markets will improve the conduct of monetary policy. But you can't outsource it to financial markets for a very simple reason. Markets don't price to what the Fed should do. They price to what they think the Fed will do. And so if you try to outsource it to markets, all you have is the markets looking at the Fed looking at markets, and the interest rate path is indeterminate.
It's the
so it just doesn't
Spider-Man
work.